Hello and welcome back to the 21st episode of The Market Lens. I'm Sam Rozzi, Manager of Due Diligence for American Portfolios, and again I'm joined by Cliff Walsh, our Chief Investment Officer. Please check out our previous episodes available on YouTube or the Studio 454 video library. We've seen the market rally off the bottom as of late, and it looks like a recovery from some oversold conditions. We've also seen a slight change in the fundamentals with earnings season here. More than 3/4 of the companies that have reported have beaten estimates. Admittedly, only less than 15% of the S&P 500 has reported, but that's above normal. Do you think this is news or noise?
Unfortunately, I think it's probably noise. Earnings, as you know, are backward looking, and the environment that companies navigated in Q1 is markedly different than what lies ahead from what we can see, which is likely going to be one with much stiffer headwinds.
Okay, so what do you think is on the horizon here?
I think one and most likely two 50 basis point rate hikes by the Fed in May and June. So we're going to see 100 basis points higher in less than 8 weeks. So that's going to trickle through the economy in the next few quarters. We're already seeing an impact in the housing and the adjacent markets. I think it's going to start to become more broad-based throughout the economy, and businesses are going to see a much tougher outlook, and consumers as well, especially those that rely on financing to fuel purchases.
Okay, yeah, I think that makes sense. And that's really just for the economy. I would imagine that investment markets have even stiffer headwinds here.
That's exactly right. I mean, I think, valuations, they've pulled back with the market coming back down, 10%, up to 15% depending on the index, but still high. We've also got the Fed balance sheet, which is contracting just under $100 billion a month, or about $1.1 trillion a year in quantitative tightening coming down the pike. But we also have the ECB and the Bank of Japan, contracting as well. So there's a huge market correlation to the Fed and the balance sheet. We've shown that, chart probably 15 times over the last number of years on our quarterly outlooks. So if you look at, $1.1 trillion in the next year, plus what's going on with the ECB and the BOJ, we think there could be a potentially 15% downdraft in market potential from here, or probably got a last couple of days. We took a couple percent of that already, so maybe another 10% from here as of this taping.
Yeah, so shameless plug here. If you caught the market webinar, I did have some pretty nice line work on there showing where we think stock market valuations as well as Fed balance sheet will look. But yeah, thank you for that. Why don't we shift gears here, zoom in onto the market lens portion of the program. There have been a fair amount of strategists calling for value over growth with higher interest rates. What are you seeing moving forward here?
It's been the right call. We had focused on value coming out of the pandemic. Obviously with the cyclical tailwind strong, we did neutralize that overweight probably a little bit too soon. We didn't see Russia and Ukraine happening, which fueled the next leg up in inflation. I think that trade is likely to fizzle. Cyclical headwinds are mounting, as we talked about in the last segment. Value is still a better value historically from a multiple standpoint, but the cyclical tide is likely to change with the Fed actions. Growth is going to become more scarce throughout the economy, which will create demand for growth stocks. And the rate hikes are going to put pressure on key value areas. We've got financials, which benefit from a steep curve. We're seeing a flattening curve, even inverting in some areas. Energy, materials, and industrials, all value segments, are going to see demand destruction and lower prices. That's exactly what the Fed is trying to do, is to destroy demand to reduce those prices. As those prices come down, their earnings power declines, and they're not as likely to perform well as equities. The long duration sell-off is also done, overdone in our opinion. As you know, long duration rates are a discounting mechanism for future earnings. So growth stocks tend to have longer, term earning streams, so they get hit harder when rates rise. So we think there's going to be a long duration rally coming in the next 3 months. Taking all of these things into consideration, we think it favors growth over value.
Yeah, definitely agree there. So do you think that there are any areas of value that could outperform in a tough economy or a tough market environment here?
It's certainly possible, but I don't think it's probable. Small value is the only area that's trading below historical valuation norms, but I'm not recommending it this time. Small caps do get hit pretty hard during economic downturns. They've underperformed, in pretty much every downturn, and I think that sentiment is likely going to be more negative in that space during risk off. So we definitely wait to go put that bet on. Investors, typically favor large cap and stalwarts when the market environment gets tough. So I think it's too early, but it might be interesting off the bottom. We're watching it closely. I think growth is going to take over sooner rather than later. We have started to see it be even on down days, even outperform on some down days, even when treasuries have been up a little bit. So I think it's good for some outperformance, at least for a short stint, but I think it's going to be a meaningful stint. As we look at sentiment and positioning, they're favorable for growth over value, and the tide is going to turn in the economy and treasuries from our view.
Yeah, thank you for that insight, Cliff. One thing that we like to look at are the correlations to growth and interest rates, or even that growth versus value metric versus interest rates. And when we see that decoupling happen, I think that's going to be an interesting change in the market. But thank you very much for all of your insights. This is our last episode before the American Portfolios National Conference, Connections 2022. That's going to be held at Mohegan Sun in Connecticut, May 18th through the 20th. Both Cliff and I look forward to reconnecting with you, our advisors, in person this year. So thanks again for joining us, and we hope you're now seeing 2020. Take care.